Goldman Sachs picked their top 15 stocks for 2024 at the end of last year. In today's episode, we're going to run through some of the stocks that they selected to see whether or not they are undervalued and a strong buy now. As always, we're going to run through the historical performance of each company. We'll look at their dividend safety, we'll run through their financial metrics, and we will put them through our valuation model, getting to our intrinsic value, our acceptable buy price, as well as our investor margin of safety, and seeing whether or not Wall Street are forecasting some strong upside over the next 12 months. So let's jump into the first stock, which we have as Eli Lilly and Company. Now, over the last year, they were up an astronomical 79%. As always, these don't include those dividends reinvested, but we can see over the last 10 years, they are up over 1,000%. They are currently trading at their 52-week highs. They offer a yield of just under 1% and currently have a very astronomically high forward PE. So let's take a look at this company, their financial metrics. Dividend safety score 96, it is very safe. Market cap 565 billion, a mega cap company. In terms of those recessionary metrics, well, they increased the dividend during the last recession, plus 4% recession sales, so that was above the average growth. Remember, S&P 500 was around negative 12% in the recession, and they also beat the S&P, although marginally, with a negative 49% return versus the S&P's negative 55. Dividend growth, lots to love in the more recent period. They increased it by double digits, 15% just last month, 14% over the last 5 years. However, over the last 20 years, it was a single-digit increase of 6% per year. In terms of dividends, well, they have been increasing those dividends for the last 8 years, with 32 years of paying it without a reduction. Dividend yield theory, as always, states that the company is undervalued when the current yield sits above the 5-year average. So we have a strong sign here of overvaluation with the yield below the 5-year average, as well as the forward PE sitting above that 5-year average of 28.2. And when we do compare it to the healthcare sector PE comparison, Eli Lilly is sitting a lot higher versus healthcare's 18.1. Now, when we take a look at the free cash flow payout, remember we do ignore earnings data. It is susceptible to manipulation by management through accounting. We focus on the free cash flow. Remember, below 60% is what we target for the majority of companies. 2022 pretty high at 77%, and this is why I always say focus on free cash flow. If you look at the earnings for 2023, it is expected to be 74%. The free cash flow actually shows us it is around 286%, which means they are expected to pay out more in dividends than generating in free cash flow, which is a red flag indicator in my opinion, something to keep an eye on. In more positive news, 2024 it is expected to come down to 64%. Free cash flow per share, whilst it has increased, although marginally from 4.29 in 2013 to 5.10 in 2022, it is very inconsistent as we can see here. So yes, it does increase over the period, but some years it does fall quite significantly. In terms of top line growth, we like to see steady moderate growth of at least 3 to 7%. 2022 wasn't that great, only a 1% increase to the top line. 2023 though, it is expected double digits, 10%. We can see some years of fairly strong growth, although we also note some years like 2014 and 17 of negative growth. Numerically speaking though, it has grown from around 23 billion in 2013 to 29 billion in 2022. Shares outstanding, now whilst they do essentially do share buybacks, returning excess cash to investor pockets, we can see fairly inconsistent, although it is positive to note they've bought back around 10% shares from 1.08 billion in 2013 to 905 million in 2022. When we focus on ROIC, remember this is one of my 7 golden dividend metrics. I do look for 10% or more. Gives me faith management are able to effectively allocate their capital. What we can see here, very, very strong, especially the more recent period, the last 6 years, around the 30%, which is very strong. Gives me faith in management and gives me that green tick when I do look at my investment thesis that I am happy with them for the foreseeable future. Operating margin, very positive the last few years as well in the 30%, so that is very nice to see. Free cash flow margin, whilst inconsistent, it does continually above that 5% minimum, although we do know in 2023 it is expected to come down to 4%, which is something again just to keep an eye on. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us the dividend safety as well as the balance sheet strength. These are the number of years it would take the company to pay off all of their debt net of cash on hand. Now 1.53 for 22 is below that 3 maximum we look for. 2023 though, it is expected to go higher, so something just to keep an eye on moving forwards. So let's jump into the valuation of Eli Lilly, and typically on the channel for the deep dives we do run through every single one of these models, getting to the intrinsic value, but as always for today's episode we can just jump straight in as we are going through a number of stocks. So for today's episode of LLY, it is coming to an intrinsic value of $663. Now in terms of that margin of safety, as always we use 10% if we believe it has a wide moat, strong financial metrics and good forward-looking data. Margin of safety at 10%, it wouldn't be a buy until $596. So right now for Eli Lilly, it is sitting around a 5% margin of safety. Now for me personally, this is too low for me to initiate a position into this company. Whilst it is a fairly strong company, a high quality, I would need to see a much higher margin of safety. What do Wall Street expect? Well, they see the price target over the next 12 months at $656, so they see upside of 4%. So me personally, this isn't one that I will be adding to the portfolio, but it is one of those stocks that Goldman Sachs do believe to be a real winner in 2024. Now before we jump on to the next stop, just to let you know that we've officially started our free weekly newsletter. If you want to get newsletters weekly to your doorstep discussing a lot of different topics, today's episode was on the 7 golden dividend metrics. It's completely free. Click on that pinned comment below and you will get sent these once a week. This week was on how we analyze stocks, the metrics we use. The next few weeks we will be doing deep dives on some very undervalued stocks, so don't forget to click on that below to sign up. The next stock we're looking at today is JP Morgan & Chase. Now we can see over the last year it is up around 26%. It is trading towards the 52-week highs and does offer a yield of 2.5% while having a forward PE of 10.7. Over the last 10 years it is up 209%. Remember, it doesn't include those dividends reinvested. Dividend safety 60, borderline safe. Market cap 490 billion, a mega cap company. And when we take a look at those recessionary metrics, well, they in fact cut the dividend during the last recession below average growth and also trailed the S&P with a negative 65% return. Dividend growth though, last summer 5%, at least above the 4% minimum we advocate on the channel to keep up in line with inflation. 9% over the last 5 years, 6% over the last 20 years on average. They have also been increasing those dividends for the last 13 years. In terms of dividend yield theory then, we see similar to Eli Lilly a signal of overvaluation on the dividend yield, 2.47 versus 2.92. Forward PE, it is showing an undervaluation signal, interestingly, with a forward PE 10.6 below the 5-year average. And when we look at the financial sector PE, it isn't too far off. JP Morgan's at 11. In terms of the free cash flow payout, now we don't typically use this as it is a lot more volatile for banks, so we focus on the earnings. We can see below 40% is the targets for the banking industry, and 2023's 25% is looking fairly positive. In terms of the earnings per share, well, it has more than 3 times increased over the period from $5.29 to $16.20, so that is positive to see. Yes, it is a little bit inconsistent. We do have a year or two where it does fall, but we do always see it bounce back up, which is always a positive sign. In terms of sales growth, very cyclical. We can see some years of negative growth followed by positive growth and so on. It is nice to see that the last full year came in at 19% increase to that top line. And we can see numerically speaking 92 billion to 146 billion in 2023. They also buy back shares. They bought back nearly 1 billion of shares from 2014, reducing the count from 3.8 billion to 2.94. Now, when we take a look at ROIE for banks, we can see 9% or more is what we like to see. Nice to note, though, that it has been increasing over the period from 10% to 16% in 2023. So that is always a good sign of management. Now, for banks, the typical metrics that we do look at, like the margins and the net debt to EBITDA, isn't really useful as they aren't especially relevant given the fact that these metrics aren't meaningful for banks. Interest is a core component of both their revenue and expenses. So for JP Morgan, let's jump straight into the valuation. And don't forget, you can click on the pinned comment below if you do want to grab a copy of this intrinsic value to get to the intrinsic value as well as acceptable buy price of companies in your own portfolio or those on your watch list. So the 10% margin of safety, again, similar to Eli and Company, we can see that this is not a buy. At 5%, again, we don't really see this as any margin of safety right now. So we do believe that JP Morgan is pretty much trading at its intrinsic value. In terms of Wall Street, well, they actually see a price target of $193, so they see upside of 13%. As always, when we do run through these companies, do let me know if any of these you have been buying over the last few weeks, and if you do believe they are undervalued and a good buy for 2024. Moving on to the third company from their list, we have Alphabet, Google. Now, over the last year, up 57%. They are also trading at their 52-week high. They don't currently pay a dividend, and they have a current forward yield of 25. Now, this is one we have reviewed a few times on the channel, which we do believe to be one of the cheapest valued tech stocks out there in the market currently. And over the last 10 years, we can see it up 421%, and it is still yet to get to that all-time highs of around $150, but we can see it isn't too far off. Now, it has a market cap of 1.84 trillion, so it is a mega cap company. And when we look at that free cash flow per share, it has been increasing 85 cents to 4.59 and expected to go even higher to 6.10 once the annual report for 2023 is released. Again, though, similar to the other companies, it isn't as consistent as maybe we would like to see, but over the longer term, if you do hold Google, it has given back very strong growth to the free cash flow. Sales growth, double-digit increases nearly every single year, 10% in 2022. It is a bit of a shame it did come into the single digits in 2023, and I would like to see that this isn't a one-off, or in fact that this is a one-off, because it has been decreasing over the last 10 years, and we want to see those top line increase by double digits in 2024 and beyond. There we have the total sales numerically as well, 55.5 billion in 2013, 283 in 2022. Shares outstanding, they've done it all. They've done share buybacks, they've done share issuances, but over the period they have bought back, as we can see, around 800 million worth of shares from 13.6 billion to 12.8. In terms of the ROIC, very positive, above 10% every year, and in actual fact, the last 3 years have been in the high 20s. So again, it gives us some very strong faith in management and their ability to move this company forwards a lot more effectively and a lot more profitable. Operating margin and free cash flow margin, both very positive, above the minimum significantly that we'd look for both. So that is good news when looking at their margins. Even though their top line has started to reduce slightly, their margins are still strong. Net debt to EBITDA, they have a very strong balance sheet. Wouldn't even take them 1 day to pay off all of their debt net of cash on hand. So what about the valuation, I hear you ask? Well, let's jump straight in to get to the intrinsic value for Google in today's episode. And we can see it at $171. Now, margin of safety, if we start off with 10%, we can see a buy up to 153, 15%, pretty much $1 shy of the current trading price. So we do see Google as having a 15% margin of safety, with Wall Street expecting around 8% upside over the next 12 months at $159. Moving on to the fourth stock, we have Amazon.com Incorporated, up 66% over the last 12 months. Again, trading at the 52-week high. Forward yield, or forward P, in fact, very high. They don't currently offer a yield, and we can see over the last 10 years, they are up around 702%, although we do know they haven't hit their all-time highs just yet of around $187. Now, 1.6 trillion, it is a mega cap company. That should come as no surprise. And their free cash flow is one area that I do believe they have lacked for quite some time. We can see in 2021 and 2022, it was negative free cash flow per share. I would really like to see the 2023 and 2024 forecasted free cash flow looking positive before it is something that I can consider. As we can see, it has been moving up very consistently in a nice form up to 2020 before dropping in both 2021 and 2022. Sales growth, pretty much a similar story to Google. It has had double digit nearly every single year, although we do see it starting to slow down significantly. 2022 at 9%, 2023 at 10% does make me start to wonder whether or not they are starting to slow down on that phenomenal growth they have consistently seen for a very long time. And their top line has gone from 75 billion to 554 expected. Shares outstanding, well, they've actually diluted your position as a shareholder if you had been buying in 2013, and they've increased that count by over 1 billion over the last 10 years. In terms of ROIC, a lot more inconsistent. In fact, Google did paint a better story, a better picture for their management. We can see it not exactly 10% every single year, with both 2021, 2022 and 2023 expected to be below 10%. Margins as well, somewhere that they do lack significantly. 2022 coming in at 2% is very, very weak. We have seen them, in fact, in 2013 and 2014, very low margins. So again, a slight cause for concern. And the free cash flow margin, it should come as no surprise the last 2 years, negative margin, given the fact that free cash flow per share was negative. Although in more positive news, it is expected to come up to 3% in 2023. Net debt to EBITDA then, not too bad in actual fact. Whilst 2022 was 1.17, 2023 is expected to drop down to 0.93, 2024 even lower. So it looks like they are having that balance sheet under control. Now, in terms of the valuation for Amazon for today's episode, we can really only use the discounted cash flow model, so we get a value of $174. Now, when we start off with that 10% margin of safety, we can see it is a buy pretty much at the current trading price. So a 10% margin of safety for Amazon, which some investors may be satisfied with, others may be looking for a lot more. In terms of Wall Street, well, they believe this has the best upside out of the ones we have analysed on today's episode, 19% with a forecasted price of $185 over the next 12 months. As always though, do let me know your thoughts in the comments below as to whether or not any of these you do believe to be strong contenders for 2024. As always, if you enjoyed the episode, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to click on that free newsletter so you can catch today's, which we did run through our metric analysis for undervalued stocks. And as always, have a great day. Do click on that pinned comment below if you want to grab the valuation model for yourself, and see you on the next one.